Are you tired of residential properties that don't use real math to come up with their value? Are you sick of appraisals that you just don't know what to expect? Or properties with already have updated kitchens and there's nothing you can do about it? Or do you have a fancy Excel sheet that you're not able to get the right use out of? If you're somebody who loves spreadsheets, numbers, and acronyms like LOI, FNMA, or CAP, we've got a show for you. Today, Christian Batchelder and I are going to be talking commercial loan products.
Side effects and conditions can include confusion and misguidance for first-time commercial buyers. Please be aware and cautious of the dreaded pro forma. Tenant improvements and balloon payments can occur, and if they persist for more than 6 months, please contact a brokerage near you. Terms and conditions may apply.
All right, let's get into Mortgage Monday today. Christian, we're going to be talking about commercial loans. We are now currently offering these, which is cool because usually with commercial products in the past, you've sort of had to go to a specific institution. You had to work with their specific person. You had to work with their specific products. It was very difficult to get a commercial product through a broker. Now there is the possibility where you can have one person that shops different commercial products to see which one would work for you. So we're going to be talking about options that consumers now have that they did not have before.
But before we get into it, today's Mortgage Monday sponsor is Monetary Metals. Sponsors like these help us make shows every week so you guys can stay ahead in your investing game. At some point, you've probably considered buying gold or silver as an inflation hedge or to add some stability to your portfolio. But unlike rentals, metals don't make you any passive income. Until now. With Monetary Metals, you can own gold and silver while earning up to 5% per year on it, paid in ounces. First, open up an account with Monetary Metals. Next, choose which qualified business you want to lease the metals to. And third, earn passive income. If you're an accredited investor, you can even earn double-digit returns in their bond opportunities. Don't let inflation and high interest rates erode your hard-earned wealth. Diversify your holdings and earn inflation-proof income with Monetary Metals. A yield in gold, paid in gold. Head on over to monetary-metals.com/big, like BIG, for an exclusive offer just for BiggerPockets listeners. Now, back to Mortgage Mondays.
So let's start off talking about what products you have recently found that we can offer and how they differ from a residential loan.
You know, we can start just by saying how valuations differ, but to answer your question directly, products in the commercial realm can basically be broken down into two categories, and it's as-is value versus renovated value, right? So the ARV. We can service a full spectrum loan product. So after a lot of feedback from you guys, a lot of requests, hey, the one brokerage helped me buy my house, but we couldn't do an apartment complex or a whole lot of flexibility in commercial. Super excited to announce, but we went and formulated partnerships that allow us now to service this realm of the market well. So products can range from an experienced investor buying a 400 unit apartment complex to a hotel to a retail strip mall, right? So pretty much anything you guys think of commercial, which is more than 1 to 4 units residential, right? So anything 5 and up, and commercial assets, which are retail, warehouse, industrial, you know, all the things that you guys think of when you think of commercial real estate. And then we've now got some really strong products to help service them.
So let's talk about what documentation someone provides when getting a commercial loan versus what they're used to providing when they're getting a residential loan.
Yeah, good question. This is a big misconception. So just to clear everybody's misunderstanding right now, when you buy a commercial asset, you are not the borrower. Okay, this is the biggest thing that people have a misconception about in commercial. You are not the borrower. The property is the borrower. Okay, so in a commercial asset, usually, you know, in residential, you go debt to income, you go FICO score, you go your reserves, you go all the aspects of you as a borrower that determines if you're lendable or not. Whereas in commercial, it's the cap rate of the property. It's what's the trailing, you know, we call it the T12. What's the trailing last 12 months of the financials of the property? What are the expenses on the property? Are there going to be renovations? What's the valuation of the property? So what's the appraisal? That's what determines what a lender is willing to lend up to and what rates are going to be accommodating that. So documentation to help facilitate that, number one is that T12 that I spoke about. That's the trailing 12, whether it's the profit and loss, the rent roll, people call it different things, but give us a 12-month snapshot of how the property has performed. If you are planning renovation, we need a budget. We need to see what's the cost per unit. You know, if you're buying a 15-unit apartment complex and you're going to spend $10,000 a unit, that's 10,000 times 15, right? We need to get that number so that we know how much renovation is going to need to be financed. And then, you know, if you do a renovation, we want to see those pro forma rent numbers to see what the property could support based on comparable rentals in the area. And the last document is a PFS. This is never, you know, accommodated for in residential, but a PFS is called a personal financial statement. This is basically your net worth worth calculation. So it's all assets, all liabilities, everything that you currently have done. It's your experience, whether it's business owner, real estate owner. It kind of breaks down to who you are as a person and if you're a good potential owner manager of the property.
All right. So with a residential loan, you're going to be offering documentation that shows your personal financial situation, and it's mostly related to your personal cash flow. Here's all my income, here's all my expenses, and then here's my credit score, and then here's the money I have in the bank to show that I can make this loan. With a commercial product, you're actually looking at the property more than the person, and the part that you're looking at that's related to the person is more their net worth as opposed to their debt to income ratio. And I'm assuming that's because on a recourse loan, they want to know if you have a net worth that can support paying back the loan in case of a default.
Correct. Yeah. And it's also, the lender cares a little bit more in commercial about the asset, really for one main reason. If the property fails or the manager or the owner operator fails, they have to foreclose on the property. So they have to take it over. So lenders don't want a portfolio of non-producing assets. Really, lenders don't want a portfolio of any real estate, right? The ideal bank never forecloses, right? Obviously, that's not in reality. But in residential, typically they're going to short sale it. They're going to sell it. In commercial, it's very possible the lender holds that asset. So it's not just if the lender has the program. It's not just if the borrower is well qualified. It's not just if the property cash flows. The lender thinks in the back of their mind, is this an asset that we would want on our books? In the event that we have to take it over, is it a strong performing asset with good management and good plans in place? In residential, you don't think about that, right? If you're doing a BRRRR or a fix and flip, the lender doesn't care. They don't care if you're going to add a bedroom or add an ADU because they don't really want it. They're going to short sell it. In commercial, they absolutely do because that could very well become an asset of the bank, right? So it has to be a bank that not only likes you as a borrower, not only likes the property to lend on, but also likes the property to potentially own in the future.
Okay, now one of the things that will qualify someone to buy a commercial property is experience. Can you talk about what that means and how it might differ from what people think?
I'm assuming people listening to this are going to fit into two main categories. Either you have experience in commercial or you're looking to start, okay? Now, looking to start, guys, I recommend do not have the first property you ever buy be a commercial property. It's completely different. There's not as much education out there. There's not as much access to capital. Like start residential and maybe somebody, the ideal client's got 5, 6 rental properties and they're looking to scale up and buy, a single asset with multiple units now. That could be a 10 unit, a 12 unit, 15, something in that ballpark. If you're in that category of people, you have basically no commercial experience, but you have enough residential that can constitute some lendability in the commercial space, which is good. That's a good thing. The alternative side of this is the person who has, been an LP or a GP on commercial properties, that's limited partner or general partner, and that you have experience managing, maybe it's renovations or just property management, collecting rents every month, maintaining the property. Those are the people who are going to get the best terms. So like when people hear that there's 20% down commercial loans out there, that's not the first person buying their first 10 unit, right? Typically, the average leverage on commercial loans is like 30 or 35% down. Whereas when you get towards that big experience level, you've owned and operated, you've partnered, you've managed, you've done all these things. That's where lenders put a little bit more stake in your experience, and they're willing to lend at those higher leverages and a little bit riskier of a loan because you have proven yourself as a successful owner-operator.
Okay, let's talk a little bit about what the underwriting looks like on a commercial property loan. So how are residential properties evaluated as far as their value, and how are commercial properties valued?
The biggest difference, like David said, is the valuation. That's the appraisal process, right? So in residential, an appraiser, anybody who's bought a residential property, this is a 1 to 4 unit. Typically, an appraiser goes out and he goes within the area. They like to do it within a mile radius, but sometimes they have to go further. And they find comparables, right? So what did this house sell for? What did this house sell for? What did this house sell for? If they're perfect model matches, those are, 1-to-1 comparables that generate the appraisal price. If they're a little bit different, maybe one has a pool, one has a fireplace, whatever, there's adjustments that appraisal needs to make. But the important part is everything is based on comparable sales in the area. Commercial is not like that. They do take commercial, comps into account just to give a little bit of stake to it. But the primary valuation method in commercial is the income approach. So what does this property rent for? What are the expenses of maintaining it? And then they calculate the average, what they refer to as the cap rate, which is kind of, you guys think of it's just a percentage of what the property makes versus what it's worth. That's a layman's terms of it. And they estimate the value based on the income. So when you see a commercial property listed for $3 million, but it's making 10 grand a month, that's probably not going to work because they need to have a cap rate that accounts for that $3 million valuation. This is why it's important that you guys, BiggerPockets has really good calculators, use them. There's cap rate calculators online, a lot of times the listing will even have it included in it. It's just important that you guys know you're not buying a home. Like, don't go on LoopNet or Zillow or whatever other commercial database and just see what comps sold for in the area. It doesn't matter because you don't know what that comp rented for, right? And rents are what dictate value in the commercial realm.
And let me just add this little quick tip in here. Don't assume that when someone says the word cap rate, they're actually referring to what a real cap rate is. It is very common, especially with inexperienced people in the real estate space, to refer to cap rates and use it synonymously with cash on cash return. They are not the same thing. You may think you know what they are because people say, oh, they're getting an 8% cap rate. What they mean is an 8% return on their cash. If the property is paid for in cash, that might be a metric that would be understandably used, but no one's buying residential real estate in complete cash. They're putting a down payment and they're getting a loan. The minute you enter a loan, that analogy falls apart. So when we talk about cap rates, the best way to look at it within the commercial space is it is a number that symbolizes the demand for that revenue stream in that market. And the higher that a cap rate is, the higher the return has to be because the less people want it. We tend to think of, if you think cap rates are cash on cash return, you're like, a higher cap rate is better. But it's not. It's more like if the asset is undesirable, you would need a higher return to justify buying it. So it's worse. There's less demand for it. And the lower cap rates go, the less return you get on the asset, but that means everybody wants it. So the asset's becoming worth more. In the multifamily space, the operator's job is to get the income as high as possible, which is usually from pushing rents or maybe adding different income streams, and to keep the expenses as low as possible, which is done through good management of the property. And then the overall macro stuff would be cap rates, like trying to guess if the market's trending in one direction or the other. The last freaking 10 years, we saw cap rates get smaller and smaller and smaller. At the same time, the rents were going up, up, up. So you won on the NOI and you won on the cap rate. And that's why multifamily did so well.
Yeah, 100%. And just to add one thing, this is by far and away, in my opinion, the most important thing to look for when you're looking to acquire a commercial property. When a broker has it listed, commercial brokers are smart. They know how to play the game, right? Because they know it's very different than residential. What they do is that they'll calculate the current cap rate and valuation and everything that they consider it's worth now. And then they'll show you the pro forma. For those of you unfamiliar with that word, pro forma means under optimal circumstances. If all the units are renovated and they're all rented at 0% vacancy and they're all at market rent and they're all performing beautifully, this is what your amazing pro forma looks like. And if that happens, look at your cap rate you can achieve, right? Like, look at this cash flow you can get, but you're buying an asset that is not there yet. Now, if you have the renovation and the value add in place to get it there, okay, that's one topic. But what a lot of people get misconstrued on in that place is, I'm going to buy this 40 unit apartment complex that has a 30% vacancy and 50% of the units that are rented are below market value. But oh my gosh, look at this pro forma over here. It's going to cash flow $40,000 a month. How amazing. Well, you may not be in a market that, number one, is going to realize 0% vacancy, and you're not really taking into account the costs associated with getting that commercial property up to what it needs to be to demand market rent, right? So guys, you get loans based on, like I said at the beginning of the show, what it's worth now, the as-is value at market rates, or you can get a value add loan. But you can't get a loan for what a property looks like now with the theoretical projection that you're going to be hitting these pro formas, because those things have to happen individually.
Yeah, I remember when I was first learning about this years ago, when I was just doing my own analysis of a residential property, right? It was kind of like napkin math type of a deal. And so I would say, well, here's the rents that I would think I would get every month. And then let's say I assume 10% vacancy. I would just take 90% of the rents and make that the income. But that's not the proper way it's done. You assume 100% of the rents, and then vacancy becomes an expense that you add in there. Like, I think I'm going to have an expense of this much vacancy. So by shortening your vacancy, you are operating your property optimally. But with commercial loans, a lot of the time they're not residential properties. Like, multifamily residential is a commercial product, but so is office space. So is flex space, so is retail. And if you lose, a tenant, if Foot Locker was one of your tenants and then they leave, it might be 6 to 18 months before you find another business that's going to come in there. Commercial is very different than residential. Don't think that because you were good at residential, you're just going to move into commercial. But for many people that might be struggling with residential because they don't love networking, they don't love the wheeling and dealing element of this, they might prefer commercial. Christian, if people want to reach out and talk to you more about commercial loans, see what products you can offer them and help decide if this is something that you get into, into, where's the best place for them to go?
Absolutely, guys. You know it at this point. TheOneBrokerage.com is our website. You can find me on social media at TheOneBroker. And my email is Christian@TheOneBrokerage.com. And just to reiterate, guys, we are in the commercial space now. Important note is that you don't get pre-approved in commercial. The property does. So when you reach out to us about a commercial asset, send us a commercial asset to underwrite, right? There's not like, oh, can I get pre-approved for a commercial asset? No. Bring us a property and we can tell you what we can finance based on the projections that you bring us, right?
All right. Thanks again. You can find me at davidgreen24.com or davidgreen24 on all of my social media pretty much. Instagram is your best bet. As always, thank you for listening to Mortgage Mondays. Leave us a comment. Let us know what you thought of today's video. If you learned something you didn't know about commercial products and what you would like to learn more about, we will take that into consideration for future videos. Also, please make sure you subscribe to the channel, like, and share this with someone that you love. If you've got a minute, check out another BiggerPockets video here on YouTube. And if not, we will see you next Monday.